But if I am going to get hit in one of my holdings because of this disruption, that is dangerous and that can hurt quite badly.
So it's this notion of type 1 error and type 2 error. Yeah. Acts of omission, acts of commission.
Yeah, yeah. The other interesting thing that he is repeatedly highlighted is that forming macro views, macro opinions, taking a market view is a gross waste of time. And still the debate between top-down investing and bottom-up investing persists. Sanjoy?
I mean, if the great man has said it, it's 100% right. This is one thing I can't agree with more. Because the future is unknowable. If anyone could read tomorrow's newspaper today, he wouldn't be amidst us. So don't waste your time trying to do things which you know have absolutely 0% chance of success. Divining there are too many moving parts. You know, Buffett made a lovely quote. This is the one I like really. He said that forecasting is like tax-free entertainment. It tells you something about the character of the forecaster. That's all.
But I think in this letter, I think he's written again, forecasters can fill your diaries or something, but not fill your wallet.
Correct. He's made that comment in this letter, in the 50th letter. Correct.
So I think the only and the best quote in this letter is about the forecasting. He's just destroyed it.
I think the important point about, okay, so at a more serious level, Raamdeo, when he was speaking about, you know, the wealth creation, the art of wealth creation, he said something, and it's these things that we can all observe which are very, what is happening to interest rates? Because interest rates have a tremendous impact on how assets are valued. And so you need to be aware, if you see that interest rates are headed down, that's a very powerful force that impacts valuation. Or correspondingly, if interest rates are very high, then equally that's working against you. It's like a headwind or a tailwind. And that's something you can see. You don't need to forecast. You know, Raghuram Rajan will help you. He'll say, I'm increasing interest rates. And I think, you know, these are the reasons why. And that you need to be aware of. So I think this market view partly relates to being aware of such things and their consequences. But these are very simple and basic things. These are not complex things. Whether the land acquisition bill gets passed or not, I mean, this is really pushing it.
I think, again, you know, this forecasting, I mean, he says that, I mean, he doesn't try to jump 10-foot hurdles, you know. He brings down the hurdle itself.
1 feet.
So maybe 1 foot or something. He wanted to do very simple, what is executionable, you know.
Yeah, yeah.
And in the nature of forecasting, there's another wonderful Buffett quote, which none of us, at least I certainly don't practice. And I suspect I'm here with the vast majority. Buffett said, if you can't hold a stock for 5 years,
don't have it for 5
don't hold it for 5 minutes. Yeah. But this is something that 999,999 people of a million don't believe in. And Buffett, if he went purple in the face saying it, wouldn't change your mind. And what he's saying is absolutely right. It's the simplest way to lose money.
Durgesh bhai, you want to share some of your more recent takeaways from the letters that you've read?
No, I would just like to talk about those areas which, you know, the perception is that he talks about only companies with consistent earnings, smooth performances. But he has gone on to say more than once that I would rather be happy with a 15% compounded growth, which is uneven, than have a 12% growth, which is even.
Correct.
So he is talking about cyclical businesses. He is talking about insurance being a cyclical. He goes about saying that if there is a business which has a reputation and a manager who has a reputation, you know, so that again, in insurance, he is showing that the impact of the manager is very huge on the outcomes.
Yes.
Again and again, he keeps talking about Ajit Jain or his other insurance managers. So he is in a business which he himself admits is not a great business, and he admits that he has got great managers.
Yeah.
So he is there, and he's buying those and keeping those, growing those. So what I think is that, as Sanjoy mentioned earlier, that there is a certain belief that he talks about only franchises, only modes, and doesn't get into too much about valuations. I think he's got those as broad guidelines, guideposts. But he gets into much more detail, understanding much more and being aware of everything else. Another thing that I found very unusual and which he's talked about in this year's letter, he is wanting the two junior guys whom he is now
Yeah.
training, he wants them to become chairman in some companies so that they actually run businesses or they oversee businesses. So the importance of being involved in some business yourself as an investor, I think that is very unusual. I don't think anybody else has talked about it with such importance.
No, he says,
And I think the guy whom I would think is the real follower of Warren Buffett in action, all of us are just talking about some things we've read, is R.K. Damani. And he's actually gone and put in his time and
practice.
money into a business.
Yeah.
Absolutely.
So
right.
I think that is something that is very unusual. I don't think any other investor has talked about this, how important it is to do. He used to say that I'm a better investor because I'm a businessman and I'm a businessman because of it. But here he is talking about training is to juniors to become businessmen while they're investing. I thought that was something.
Outstanding. Yeah. Absolutely.
The other thing that you mentioned about the change of his letters from the earlier times, if you see the entire letters that he wrote as partnership, that is a period of more than a decade. He has never used the word culture in all those years. And this last letter, I think he's used it almost 10 times.
Yeah.
So I guess this is what is the evolution that I would think has happened with him.
Right. Right. This interplay between business and investing, you want to share your own experience as a businessman and an investor and how, being a businessman has helped you.
yeah, one of the biggest realization being in cyclical business is that nothing happens in a straight line. You could see, how after listing, Motilal stock share prices have moved. People become so pessimistic that even from the breakup value also they want to throw it. At just 12 months back, and now today at 3 times, 4 times of the price, you can't supply enough. So non-understanding of the reality of businesses, that nothing happens in straight line. Something is, businesses live by their reputation. If it is cyclical business, it better be cyclical. Otherwise, something is wrong in the entire system. So businesses will remain cyclical if they are cyclical, and investors have to behave, understand. And I think those things because the misunderstanding of the investors as a whole, how the businesses work, and they instead of buying maximum at that point of time, they actually sell it. So it creates a massive opportunity for the people who understand the characteristics of the businesses. Where he says, that if there is a fight between reputation of business and reputation of businessman, ultimately the reputation of business will prevail. So if something is a fantastic business, but it turns out to be cyclical, always at the bottom of the cycle you get a fantastic opportunity to buy those businesses at fraction of the prices. So, of course I don't like to buy a lot of cyclical businesses. One of the things I don't practice is to buy, because you can't really figure out this, cyclical. So I want to be permanent bull, and I want to buy something which is working very well, and where I think there is not going to be too much unpredictable earnings cycle. But there are a lot of practitioners who make a lot of money at the bottom, buy and sell it multiple times of that.
Yeah. Yeah. Sanjoy, the great, good and the gruesome, your thoughts on that framework?
That's right. That's absolutely right. This great, good, gruesome idea is an incredibly powerful idea, because if you look back at any of us, at our own lives, it's the easiest way to learn this. And let's say we are not Buffetts. We have bought 100 companies in our life or 80 companies in our life. You will find invariably that 90% or 80% of your gains, of your total accreted value to what you're worth, has come from 5 or 6 or 7 companies. Absolutely. And typically those 5 or 6 or 7 companies are fantastic companies. And that's it goes back to Durgesh, what he said. So just focus on trying to buy those 5 or 6 and leave out the other 85. If you do that, because the gruesome companies only knock off money from you. You lose money. If you buy poor quality companies and then you combine it with the wonderful Indian manager, you have an absolutely potent cocktail for getting busted. But people keep on doing it because the human mind loves a narrative. It wants to see a story where there is an explanation, a cause and effect relationship. That's why brokers are so popular. No? Why was the market up today? Sir, it happened like this. So actually nobody knows why it was up. But if you tell a client that this is why it happens, he has people like me, we have a great sense of comfort. Okay, samajh aa gaya.
I'm on top of it.
Oh yeah, I'm on top of it, basically. That's the importance. That's why these gruesome businesses should be avoided. Because they'll do the damage and then the mathematics of investing is against gruesome companies. If 100 goes to 50, you've lost half your money. But to go back to 100, just to get back to square, you have to double.
Absolutely.
So the mathematics of investing explains the power of the great, good, gruesome idea. If you think about it.
Yeah. One of the things over a period of time, actually, I was also like every day going up and down with the market, bothered about the market, buy and sell. You have to be active in the market. If you are in the stock market, doing everything interesting every day.
Activity.
That's how I started. But over a period of time, somewhere this bringing focus, fewer number of companies, buy and hold. Buy and hold is a huge concept given by.
Yeah.
So that was one. Then I think you wait for the fat pitch. Really easy ball, which you can straight hit to the 6. So that when your framework is ready, then you can see the big ball coming in. And that's why the number of trades, number of stocks you are buying or making a judgment has come down. At least that has been the change, if you might have observed me over the period of time.
And I should tell you this, Navin, what Raamdeo is just telling has had a huge negative impact on me. You know why? Say, earlier I used to pick up the phone and say, boss, koi tip vip bata. So Raamdeo used to give me a tip. So mera kaam ho jata tha, mera paisa ban gaya. Now I ring him up for 6 months, he has not given me a tip yet. I've been ruined. So it's a powerful phenomenon, how the common man gets hurt by all this.
Yeah.
Think about it.
Yeah. You want to slice and dice this good versus gruesome a little more in terms of the bank account concept.
Yeah. So in that paper he has said very clearly that it's like a bank account. So you have 3 types of bank account, 3 savings bank account. So good business is the one where you put your money, say you put a crore and it gives you 20% return. Fantastic. Cost of capital is 10%, you go to SBI, they'll give you 9%, here it gives 20%. But so you are making say 20%, so you make 20 lakhs. But if you want to double the profit, 20 to 40 lakhs, which is always the urge, you are never happy with 20 lakhs. You want to double the profit. That time you have to put another crore rupees to the work. So that's a good business. All HDFC Bank, Axis Bank, ICICI Bank, all the banking fraternities like that, all the utility companies and all. To double the profit, you have to put
double the money.
Yeah, because the return is somehow, because the competition or whatever, it is capped at about 20%.
Yeah.
But they can deploy a lot of capital, which is good business. You can earn 20%, but you can deploy a lot of capital, so you are earning excess return, a lot of it. That's a good business. What is a great business? Great business is the one bank account where you first year you put in 20%, next year it gives you 30%, third year it gives 40%, then it gives 50%, because in the same franchise, the growth is on, you're not putting up any extra capital,
but
your working capital cycle is getting crunched, and you are producing just higher and higher return on the same, or your fixed cap, basically you have 2 capitals, one is fixed capital and another is the working capital. So you have put up huge capacity at the beginning, so your return is low, and working capital it works on so-called negative capital employed, negative working capital, like we have seen in Hero Honda. They work on the suppliers' money. They work on negative working capital, and so much so that at one point of time they're working on negative capital employed. They don't use any capital. That's the ultimate form of making money, and then on top of it, you have growth.
Yeah.
If you don't need any capital, and then you can grow at 20%, what more you want?
So the way for people like, simple folk to figure out this great, good, gruesome mathematically is very simple. It's basically incremental return on capital employed. Incremental return on capital employed will be higher for the great businesses, the same as it is in the past for the good businesses, and declining for the gruesome businesses.
Yeah. But Guru sum was really tough to understand. Why? Because Guru sum is not only about low rate of return or loss making.
But growth combined with
But the managements are not there to sit and just squeeze the cash out of bad business.
Yeah.
They are supposed to grow.
Yeah.
Every single manager is supposed to grow. So what happens is, you put another 10,000 crores into the useless business.
Yes.
And you keep coming to the market and people keep giving money also.
Yep.
And there are private equity guys who love to give this kind of money. So, aviation. Before one is folded, three more are in the queue. I don't know how this money comes. And the other guy is going out of the business because of losses. A huge empire is burnt just the mistake of starting an airline. And still there are three more guys who want to, with an empire, to go into that airline business. So what I'm saying is a lot of people don't understand the destructive power of gruesome businesses. And there are too many of them.
Right.
They compound in reverse.
Yeah.
Just like the great businesses compound this
he
way.
said the time is friend of good businesses or great businesses.
Enemy.
And huge enemy of bad business.
Yeah.
Because you can actually go to zero. And we have seen a lot of companies going zero.
Yeah.
Good thing is that here there is no bankruptcy law. So still all these bankrupt businesses are hanging around. In US and all, these companies would not be there. Nobody will touch them.
Yeah. Yeah. Durgesh bhai, the latest annual report, shareholders letter once again makes a very strong case for equities over all other asset classes towards the end. And
I think that was very interesting, particularly because in our country, it is assumed that bonds are safe. If you see the government laws also, insurance money or pension money or everything is guided only into bonds. And equities is a no-no. And here we have this guy who is clearly saying that currency denominated instruments are the riskiest of investment. And if you see India in particular, from 1947 to now, I think a major part of the period we've had almost negative interest rates.
Yeah.
There have been very few patches where we had. So even when he was talking about the gruesome businesses, I think when you adjust for inflation and you see the last 30, 40 years, whatever data we have, not many companies have been able to beat inflation and stay even where they were. So it is a tough environment out there, and I think it's very important to find a combination of a good manager and a good company for any investor.
yeah. Actually, on that inflation point, that's the other evolution that we've seen in his statements in terms of definition of investing, which is to sacrifice.
Yeah, so in 2001 and all, he said, what is investing? He said the definition of investing is laying out today's money to get more money in the future.
More money in the
More
future.
money in the future. Though he was knowing the importance of inflation even then,
Yeah.
but still he didn't define it. But in 2008 or 9, he said, now we have made more rigorous in terms of giving definition. So Buffett himself became rigorous about the investing.
Only
and
as
in 2008 or 9, he said, investing is about surrendering your current purchasing power to get more purchasing power in the future.
Yeah.
So that your importance of beating the inflation, which is your first enemy, particularly in India, where 34, 35-year history of inflation is about 8.5%. Nobody likes Raghunath, the current governor, because he wants to fight that demon once for all. So clearly, we have learned to live with 7-8% inflation, and what is so great about 2-3%? So, I think understanding that, really return, and that's where he's talked about even 2-3 years back. There are 3 types of asset classes, where 3 types of businesses. He said there are 3 types of asset classes. One which doesn't yield anything, gold, your artifacts and all. Second one, the money market instruments he talked about, which is nothing but inflation beater or inflation leveler. It tries to keep your purchasing power at the same level because it just gives you as much as inflation. Actually, it's much lower than that because post-tax it is not that much. The third is the equity, which is the main, kind of exponential asset where you can get, if you buy good quality equities. See, in equity, you cannot buy anything in equity. That's the big problem with equity. You buy gold, you get everywhere 24 karat gold. In equities, you get 4 karat equity, you get 24 karat equity, you get 240 crores equity. So, and lower the carat, higher is the shine. So the confusion in equity is big time. And that's where I think active managers come, and people have to use these professional skills to figure out difference between a great business and useless businesses in their portfolios.
And that's also, Navin, the reason why none of the great investors smoke. Because 100 rupees a day, every day, is 3,000 rupees a month, 12 months a year, and you see how that 3,000 rupees a month for 20, 30 months, 100 months compound, then what is your opportunity cost of smoking?
Yeah.
Then you should just stop eating also.
No, I'm not in the grades here. But none of the great investors will ever smoke only for this reason. They realize the opportunity cost, not because they're concerned about their health, incidentally. People have this mixed up.
Yeah. Great. Thank you very much. We'll now open the floor for question and answers, and we'll also take questions from the 6 centers that are linked to the auditorium today. You can raise your hands and the mic will reach out to you. We have quite a few of very many questions here.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.